Good afternoon, everyone. Welcome to our webinar this afternoon, which is a market overview. I'd like to just begin by going back over what we covered last time. You may recall that last time I gave you a broad overview of where I saw the markets in the context of the long-term trends. And I mentioned then Nikolai Kondratiev, the Russian economist, and his 54-year cycle of commodity prices, which I explained was really a debt clean-out cycle. And then I talked about John Maynard Keynes, who wrote his book in 1936 and explained that the Federal Reserve Bank had handled the 1929 crash incorrectly because what they should have done was to inject cash into the American economy to compensate for the wipeout of wealth on Wall Street. And then I talked about Alan Greenspan, who, of course, was a student of John Maynard Keynes, and the events that surrounded the 1987 crash when Ronald Reagan was in his second term of office and was looking to fight an election or to be involved in an election for the Republican Party in 1988. And Greenspan used the techniques which were described by John Maynard Keynes in his book in 1936, and he got the G7 to pump money into the economy, into the world economy, to compensate for the wipeout of wealth in the 1987 crash, and that had a dramatic impact on markets. The stock market fell from October 87 to about March 88, and then it turned and started going up, and 18 months later it made a new all-time record high, and this was such a successful action in economics that Alan Greenspan was assured of his position as governor of the Federal Reserve Bank in America for the next 25 years. And indeed, after he left, his successor, Ben Bernanke, continued with the same policies, and Janet Yellen, who's followed on from Ben Bernanke, is carrying on with the same policies. And then I said that this is what underlies the enormous cash injections that were made over the last 10 years since the subprime crisis of 2008 into the American economy, and indeed all the economies around the world, in what is called quantitative easing. So altogether, the governments of the world, the central reserve banks of the world, have pumped more than $12.5 trillion US into the world economy since 2008, since the collapse of Brothers and what has become known as the subprime crisis. That massive injection of cash, which was basically printed money, caused the market to turn in 2009. And there on your screen, you can see the S&P 500. You can see the turning point here where I've marked it as bull market begins. And then that went up, and there was a first correction, a second correction, and we're basically in the middle of the third correction now. But this bull market has been going on for 9 years, so it's one of the longest bull markets in recorded history. If I just zoom out now to look at the current correction, which is going on right now, you can see here's the correction. I'm just going to go to a candlestick chart, I think, at this point. And here you can see more clearly what we are looking at. We made a record high at 28.72. That was followed by a 10% fall down to the support level at 2581. Then there was a substantial rally, and then the rally collapsed back to the support. It's very interesting that support level of 2581 held at that point, and then the market rallied off that again, and we're in the middle of that rally. You can see that I've drawn here a long-term trend line, downward trend line, which seems to indicate some sort of a ceiling to the current S&P 500 market, certainly for the last couple of weeks. And we are expecting that the market will break up out of this triangular formation and go on to make another new record high. A lot of analysts are saying that this bull market has had a really good run, and it's due for a major bear trend. We do not believe that that is going to happen. We believe that this is a correction and not the beginning of a major bear trend. The correction has now been going on for 4 months, so it's matured quite a lot, and we do expect that some sort of upside breakout is fairly imminent now. That's what we believe at this stage. Now, obviously, the thing that is driving this S&P 500 is the growth in the American, excuse me, the growth in the American economy, which has been pretty strong. The American economy for the last year or so has been producing about 250,000 new jobs every month. And that kind of growth on an economy of that size is absolutely enormous. It's dragging the rest of the world up with it, particularly Europe, and of course China and Japan, and obviously eventually also South Africa. So the growth in the world economy is beginning to become a major factor. And we can see this particularly in the oil price. So I'd like to just now go and have a look at that oil price. Just put this into a line chart, and then I'm going to add a bit more data on the screen here so that you can see the pattern. There, if you look at this chart now, you can see how oil prices collapsed in the second half of 2014. And that was mainly due to the exploitation of shale gas, particularly in America, where new technologies for extracting oil from shale gas were developed. Those technologies allowed shale gas generally to be extracted at about $50 a barrel. And that was about a third of the price that was ruling at the time, which was around up to as high as $150 a barrel. And it caused the market to collapse. So in the second half of 2014 and then on into 2015, the oil price fell and fell. It eventually reached a low point of $28 a barrel in January of 2016. And that is generally reckoned to be the turning point in the commodity cycle. After that, commodity prices started to go up, and not least of those was oil. As you can see here, this upward trend has now taken us as high as $80 a barrel, which is a significant jump from the low point of 28. And of course, at $80 a barrel, the shale oil companies are starting to make money again. And so that kind of places a ceiling on how high the oil price can go. But this rising oil price represents a growth not just in the American economy, but in the economies of countries right around the world. That is leading to a greater demand for motor vehicles, so obviously a greater demand for products of all different kinds, and almost every product that you can buy uses an internal combustion engine at some point in its product life cycle. So from when it is raw materials until it reaches you, the consumer, at some point, and often at many points, it will involve the use of oil through an internal combustion engine to transport it from one place to another. So oil is a key component of the consumption of products. So as the consumption of products goes up worldwide, so the consumption of oil tends to go up. Also, of course, more people become wealthier. They can then afford motor cars, and they start driving those things. So we get a rising oil price, which to some extent is mitigated by increasing production of shale oil, and to a lesser extent is mitigated by obviously the spread of alternative energy forms, and particularly renewable energy forms. But for the moment, oil is still the primary mechanism used to transport everything in the world. And I expect that to continue for some time. So the oil price is very important. Obviously, it's important to South Africa. And especially it's important when you combine it with a study of the Rand. And let's go there next. So I just want to put a Rand chart on the screen for you. So this is the Rand against the dollar. And here you can see, I'll just zoom that out a little bit for you there. You can see how this Rand chart has formed a channel, a strengthening channel. So this chart is basically inverted in the sense that when it's falling, the Rand is getting stronger. when it's rising, the rand is getting weaker. There you can see on the left-hand side the point where Nene was fired as Minister of Finance, and of course, Pravin Gordhan was appointed immediately. And then when he was appointed, the rand started to strengthen and strengthen and strengthen. Then Gordhan was fired over here, and we had the events leading up to the ANC conference at which Cyril Ramaphosa was elected as head of the ANC. Following that, there's been a very strong trend in the rand, strengthened all the way down to about 11 Rand 50 to the US dollar. And then I think that it became apparent to the ANC that if they allowed the strengthening trend to continue, the mining industry in this country would completely collapse. As it stands now, about 60%, for example, of platinum mines cannot operate profitably. So they allowed the rand to weaken again. And now the rand is in a weakening pattern, and it's moving back towards this upper trend line, which means that it could continue weakening until about 13 Rand 50. Of course, this has a major impact on the fuel price. And one of the nasty shocks you're going to get in the near future, in fact, next week, is that the petrol price in this country is probably going to go up somewhere around 85 cents a litre. And that is on top of last month's, I think it was 72 cents a litre price increase. So the petrol price in South Africa is approaching 16 Rand a litre now. And that will obviously eventually feed through to inflation. Luckily, our inflation rate is pretty low at the moment, around 4.5% per annum, and well under control. And really, that is the main factor that is holding our economy together, is the fact that our currency has been relatively stable. So those are just some of the broad brushstroke trends that are going on both locally and internationally. The South African economy is recovering, but it's taking a while. And obviously, our economic recoveries in this country are generally export-led. So we have to wait for overseas economies to get going, and they demand our raw materials. The prices of those raw materials go up, and then we start to make money here and employ more people. And that has a knock-on effect. All right, so let's just leave that. I just want to look at a couple of things in a couple of shares and point out some things to you that have taken place, some interesting things that have taken place since I spoke to you last. The first one I just want to look at is a share called Tiger Brands, and this is under the code TBS. So as you are probably aware, the government investigators have established that Tiger Brands was responsible for the listeriosis outbreak that we had, in which 200 people died. And what is interesting, though, about this share is that the listeriosis was actually reported here. You can see the sharp drop in Tiger Brands' share price as that was reported. But prior to that, we had what technical analysts call a head and shoulders formation. I don't know if you can see that. There's the left shoulder, the head, and the right shoulder. Typically, the left and right shoulders are lower than the head. But once you get a breakdown out of that formation, as happened here, then you're into a downward trend. Now, what is interesting is that this head and shoulders formation came well before the listeriosis outbreak was reported. And that tends to imply that somebody inside Tiger Brands or some large shareholder was aware of the situation before the rest of the market and started offloading their shares. And that caused this head and shoulders formation before the listeriosis outbreak was reported. And this goes back to what I've said on many occasions in the past, that there are always insiders. Whenever there's an event in the market, there are always insiders, people who know what's going on and who inevitably trade on that knowledge. And they cause certain recognizable formations in the marketplace, like the head and shoulders formation. And I'd like to now just talk about another example, which is a company which has been very much in the news, and that's Steinhoff. I know that you all have been following Steinhoff. Just bring a bit more data onto the screen here. Here you can see this is where the Viceroy report was published. and it caused the share price to drop from 55 Rand approximately down to about 5 Rand. Since then, it's tailed right off, and I see it's now trading for about 1 Rand 15. So it's virtually lost all of its value. And this was an unthinkable event. I mean, this was Christo Wiese's company. It was a massive blue chip. Every one of the big institutions in South Africa had a large holding of these shares. And what is interesting is that the PIC, the Public Investment Corporation, which basically runs the pension funds for the civil servants in this country, lost 17 billion Rand when Steinhoff collapsed. Coronation, which is a very well-known asset manager in South Africa, they lost 14 billion. Alan Gray lost a lot of money. The institutions, the fund managers together, lost about 200 billion Rand when the Viceroy report was published. And obviously the Viceroy report proved to be pretty much correct. And there was some dirty work going on there, and it has been steadily coming out, and as it's been coming out, so the share's been collapsing even further. But what's interesting is if you go back 15 months from when this Viceroy report was published, and you go back here to this triple top, which I've identified here, you can see that technically it was quite clear 15 months before Viceroy's report was published, in between about March and August of 2016, that something was not altogether right with Steinhoff. This is what we call a triple top. So this is the first top here in March. The share makes a top and it falls back. Nothing unusual about that. Nothing in the share market moves in a straight line. So this is entirely to be expected. And indeed, it's healthy. What is scary is that the second top did not exceed the first top. That is scary. Normally, in a bull trend, when the share is going up, you'd expect this rally here to exceed that high point there and to take the market a little bit higher. But it didn't do that. It fell back and there was disappointment. And as you can say, it made a low here, which was lower than this double low here. And then because it's such a solid blue chip share, it again rallied. And again, it tested that same level, but this time it didn't even get as high as this top, never mind the first top. So what you've got here is a declining triple top. And any technical analyst, anyone who follows charts regularly will tell you that is an extremely negative thing to happen, where you get a share attempting to break up on two separate occasions, to break up to a new high and failing on both of those occasions. So then the disappointment, it collapsed back. But you'll notice that even here, the share was trading around 88, 89 Rand a share. And then it fell back heavily on that disappointment, right? Now, what I'm suggesting to you is that somebody already in Steinhoff, some big player already knew that all was not well with this company. And they were selling out of their portfolio at this time. And they caused the triple top. And then the market slowly drifted out, still worth about 55 Rand right up to this point. Then the Viceroy report was published and we had the collapse. But if those asset managers like Alan Gray and Coronation and the PIC and so on had been looking at technical analysis, they might not have been invested in the share at all. I'm sure no private investor who was following his charts would have seen this triple top and said, oh, I'm going to stay in the share. I think that would have been insane. This is obviously very negative from a technical point of view. But then you see the fund managers in this country do not follow technical analysis. So they would not have been aware of this. Okay, just on a slightly change of subject, I'd just like to look at the Bitcoin market just briefly. Let's just get that on the screen for you. Yeah, this is Bitcoin, a very interesting market, Bitcoin, because what we've got here is a cryptocurrency. It's one of, I believe now, about 3,500 cryptocurrencies in the market. But what was interesting is that initially this chart is what we call an exponential. In other words, it went up at a rising speed and eventually reached this incredibly high level here before collapsing back. but no exponential chart like this is sustainable. And as a technical analyst, as a chartist, you would know that. You would know that you cannot go, nothing can go up in value exponentially. That cannot happen. So sooner or later, when you see a chart like this, you know it's going to collapse, and it certainly did. It collapsed right back, and then it came back up, found resistance at this level here, $11,500 per coin. It's then collapsed back to make a new lower low. It made a lower high over here, double top, okay? And maybe I can just expand that a little. Okay, so there's your double top. And then since then, it's fallen back. And we expect to break this low here. That is what we expect. So just looking at this again, it's very difficult to know what's going on in the Bitcoin market because obviously it's a blockchain-based currency that's not under the control of any government. So nobody really knows what's happening. But I can just tell you this pattern of a resistance at this level, which is lower than that, a new lower high at this point, and a double top to boot, a lower low there, and now we're drifting out here. So if this makes a low below this low here, then I think we can expect the Bitcoin market to collapse pretty convincingly. Anyway, my message to you is that technical analysis, the study of charts, is the private investor's answer to insider trading. You will never, as a private investor, have all the information that you need to make accurate share selections. But there will always be insiders in whatever situation you're looking at, and they will always trade on the inside knowledge, and they cannot hide those trades from you. If you know what you're looking for, you can see that insider trading in the market. Folks, thank you very much for listening to me. I hope that you'll come along to my next webinar. When I give it, I'm not quite sure when that's going to be, but no doubt it will be published on the website. Thank you once again for listening.